Monday, August 24th, 2020, Maneco 64, home of alternative economics and contrarian views. Today we're going to look at what would happen if the Federal Reserve were to stop printing money or buying assets, doing QE, quantitative easing. It's a reasonable question to look at, especially with what's going on right now with precious metals. A lot of people, of course, like me and others, saying that the Fed's not going to stop. Precious metals are in the bull market. Fiat currencies are in the bear market. Yeah, it's good to ask questions that have some doubts. Nothing is ever certain, I would say, in the world. But be as it may, let's look at what would happen if the Fed were to stop printing money. What that would mean basically for the whole system would be higher interest rates, and especially for U.S. Treasuries. And that would seep through into the corporate bond market because they're riskier than Treasuries. U.S. Treasuries, for some reason, they're called risk-free rate of return. So it's the base of the monetary system, the fiat currency monetary system, of course. That would lead to higher interest rates all around. The policy we've had since Greenspan in 1987 is of ever bigger bubbles, ever bigger bailouts by the central bank, by governments working together with the central banks, ever lower interest rates. Have you noticed that the Fed funds rate is kept going down since the time of Greenspan, and it keeps going lower? After every bubble, interest rates do go back up when things get a little better, but they never go back up to the previous level. They don't make a new high. Well, that's not normal. That's artificial. You would think a borrower that only had $1 trillion of debt 40 years ago, but now has almost 30 trillion, would be paying higher interest rates, but it's not. And that's Uncle Sam, of course. And that's been, created by the artificial manipulation of interest rates, by the money printing or the asset purchasing by the central bank. Central bank, how do they purchase assets? Well, they just type an entry into their balance sheet. They create reserves. Those reserves are used to buy treasuries, mortgage-backed securities, now even corporate bonds from the commercial private banks. So the private banks send the assets to the Fed, and the Fed credits those banks' accounts with reserves. Those banks, of course, have more reserves. They can either keep those reserves with the Fed, or they can use that to lend it to the public, to corporations. And that's what's been happening. It's artificial. And the problem with a fiat currency credit bubble that von Mises has talked about, Ludwig von Mises from the Austrian school, is that once you start down that path, the only way to stop the credit bubble, and I would say the credit bubble is almost 40 years old, the only way to stop it, there's two ways. One is to pull the plug or raise interest rates, stop money printing. The other one is eventually the currency collapses because you create so much of the currency that people lose faith and confidence in that currency. And that's what we're seeing now, I think. And why the currency? Well, because the flip side of debt in a fiat currency system is the currency, of course. So just give you an example, what would happen to interest rates around the world, around the sectors. And there is precedent for this. It would be what happened in Europe during the sovereign debt crisis, as you can see here. Interest rates were very low for a while in Europe. And then all of a sudden, they just spiked. And that was the European debt crisis. And of course, Mario Draghi of the ECB came and said he'd do whatever it takes back in 2012. And that artificially has driven interest rates back down. So what that would mean is that, first of all, Uncle Sam would have a very hard time paying interest on all the debt. Right now, I think the highest that Uncle Sam is paying is around 1.5% for the longer dated paper. And that would mean treasury prices would go down as well, would collapse. A lot of the financial sector, the system, uses treasuries as collateral. So that would mean massive selling of all other assets. And even worse, corporate bond markets, especially the junk stuff, would go through the roof. Companies would go bust. The banks, of course, would be in trouble. So you would have a complete collapse of the system. And you might say, well, higher interest rates are bad for gold, but not in this case, not in the case where the whole system is imploding. And I'll show you what would happen to gold. And you just have to look at John Exter's pyramid. John Exter, of course, was a central banker. He helped create and found the Central Bank of Sri Lanka, of the Philippines. He worked for the New York Fed, and he was a gold bug as well, by the way. And I'm going to put a link to one of his essays or one of his speeches about what U.S. Treasuries really are. He calls them IOU nothings. Of course, he's passed away. He's not around anymore. He was warning people back in the 70s about what was going on then. So this is what would happen if the Fed raised interest rates. This is his inverted pyramid. The top are the riskier assets. And if you move down to the bottom, they're the less risky assets. Gold, of course, is at the base of the monetary system. And that's not me saying that. That's John Exter. And you could add silver to that as well. So that's what would happen. The whole system would implode. All the liquidity would flow to the safe haven of gold and silver. So that's why I'm not concerned about having precious metals. Yes, the short-term price movements are annoying, but you need to stay the course. And just to show you here what's going on in terms of the Fed's balance sheet, and the last time they tried to stop printing or quantitative tightening to normalize things, right, to raise interest rates, and they did that back in 2018 and 2019. They raised rates again. They shrunk the balance sheet. But then quickly in September 2019, all the banks were in trouble again. We had the repo market debacle where interest rates, overnight rates, went from 2% to 10%. So they've had to quickly reverse it, as you can see there. They started asset purchasing again, or money printing. So as I've said many times, looking back at history, at countries like France back during the 1790s, when they started issuing the assignats, it was just going to be one issue to get the economy going. The effect from the drug doesn't last very long, so you have to keep taking even bigger doses. And if you stop taking it, you just break down completely. And that's where we are in terms of monetary situation. So yeah, I think the whole system would come down. You wouldn't want to be in the financial system. You wouldn't want to have any financial assets if the Fed were to start raising interest rates, start unwinding their balance sheet, because unwinding their balance sheet is basically raising interest rates. So the other side of course, the other option is that they keep doing what they're doing, and we're seeing what's happening, right? The currencies are continuing to sink, and they're going to have to keep doing that. So that's how I see it. You might not agree with me, but from reading history, from studying the subject, I haven't seen any situation in which monetary authorities like central banks or governments were able to unwind from such a situation. And right now, the debts are so huge that it's impossible to pay them. You'd have to tax the whole economy 100% for years to try to pay off this debt. And then you would kill off the economy, of course. So that's what would happen then. It would be total disaster. I don't think the dollar would go up. Yeah, there would be some demand for cash before all the liquidity flowed into the precious metals. So with that, let's quickly look at where the markets are this morning in London. It's 7:11 actually, London time. I'm quite early. So we've got spot gold, 1934.20, down about $5.50. Range has been 1929 to 1946. So we're still like going nowhere at the moment. We are off the recent lows at 1860, but also off the highs at 2075. Silver is down about 30 cents or 1.15% at 26.50. High's been 26.90, the low 26.27. I've heard people talk about the fact that there is a shortage of silver. There's very little silver out there. I think it was Alistair McLeod, especially physical silver in London, and that we have to wait and see what happens in September. That maybe a lot of people are going to ask for delivery on the COMEX. We'll have to wait and see. It could be something interesting. But as I said, in the long term, silver and gold should actually not even go up. I think it's the fiat currencies that are going down. Yeah, there could be a little bit of speculative buying that helps. What about the stock market? There's a lot of news about President Trump trying to get something to inject onto people before the elections. Yeah, it almost feels like they want to keep the markets going higher. So right now, the Dow is up 112, up 0.4, the Dow futures at 28,040. S&P is up 12 points at 3409, up 1/3%. And the NASDAQ 100 futures up 63 at 11,620. The stock market, of course, as well, would implode if the Fed started or stopped printing money, started raising rates. It would be completely annihilated as well. The thing is right now is that the stock market is not being levitated by fundamentals. We're seeing the economies not come back to normal. We're seeing talks of another lockdown and second wave, and it looks like that's what the powers that be want. So I think it's very dangerous to stay in the stock market, unless, of course, that's a small part of your wealth and you've had a long-term investment in companies that you believe in and that you know about. But what I'm trying to say here, I don't think you should be chasing the stock market and stocks, especially the tech stocks. Currencies, we've got the pound up slightly, only 0.08% at 130.98. The euro as well, virtually unchanged at 118. The dollar is unchanged versus the yen as well at 105.80. And it's down 0.1% versus the yuan at 691.40. WTI crude is up 0.2% at 42.40. And to finish off with the bond market, the treasury market, that's the most important market in terms of the credit markets because it's the risk-free rate of return. That's what they call it. I'm not saying it is. But yeah, yields are continuing to tick lower here. So the 10-year yield is at 0.628, down 1.2 basis point. The 2-year is at 0.145, unchanged. So there you go. That's what would happen if the Fed stopped printing money. It would just bring everything down, especially now that Uncle Sam has really turned on the borrowing spigots, especially with the economy being so weak and a lot of people out there being concerned about what's going on health-wise, being concerned about going back to work. It would be disastrous if interest rates started rising. Is it any wonder that when Powell is asked about raising interest rates, he always says, we're not even thinking about of raising interest rates. So there you go. That's my view. Please comment below if you have a different view. It's always great. One of the reasons why I made this video is because someone asked me, what if the Fed stopped printing money? So there you go. Thank you very much for all the feedback. And if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to the channel. And also make sure you click on that little notification bell below to be notified of all my new videos. I've been hearing a lot of people are not being notified of my new videos. And I make videos every day, as most of you know. So I wish you all a great day. Take care. Bye.